Hello, good evening, everybody. My name is Reginald. I'm from Schroders in Singapore. I don't think I'll be half as entertaining as the LED Diablo guys or the LED Lion Dance guys, but if you'll spare me half an hour, I'll try to give you the views from Schroders for 2020, specifically the predictions for 2020 and how you can make money despite the market conditions, despite this being duct tape banana conditions. And I'll be happy to come back in 12 months' time to review the positions, whether I was right or wrong. So let's go right into it. But first, let me set the scene by asking one question. When is the longest economic expansion? Was it in the 60s, the 1980s, 1990s, or now? Well, the answer is now, as most of you would have guessed. Yes, it's been a long, long time, more than 10 years since the global financial crisis, and it's been, well, as Jitun said, one duct tape banana moment after another with interest rate cuts, quantitative easing, Donald Trump, etc., etc. But it's been 10 years and more, and what we think is that it will actually continue. It's been a very interesting time in markets, and last year is very, very different to this year. If you just cast your mind back to 2018, it was a disastrous time in stock markets, in financial markets. It was down, everything was down. 2019, a reversal. So it changed a lot, didn't it? And what happened over the 12 months really was the outlook for interest rates. If you remember, 12 months ago, if I was standing here, I would be telling you, if you look at the chart here, I would be telling you that the US Federal Reserve, was looking at interest rates of 3%. So if you look at the chart on the left, those are the blue bars. They were looking at interest rate hikes up to 3%. Turns out they were completely wrong, because a few months after that, they started talking about cutting interest rates. And that's where we stand today, and interest rates are 1.75% today. And so what has changed over the 12 months? Well, we can talk about markets slowing down, economic slowing down because of the trade war. We can talk about all the uncertainties when economic growth has been going on for more than 10 years. Call it what you will. It's just been difficult times in markets, but things have changed, and we are governed by many different rules today. But what does the data suggest today? So this is the Schroders Business Cycle Indicator, our own proprietary tool for which we are looking at where we are as far as the US economy is concerned. Now this goes back quite some time to the late 70s, but generally what you see is that if you look to the right, we are in the green and the yellow sections. That's expansion and slowdown. The blue, when we were around 8, 9, and 10, was the recession years and then the recovery years. So here we are, yellow, green, yellow, green. What happens next is the question. 1 year ago, if I had asked you this question, even 6 months ago, a lot of you would probably have said, recession, inevitable, we're going down. Today, what we in Schroders are saying is that economic growth will actually stay very stable. Globally, we are looking at 2.6% GDP growth for 2020. And the same number for 2021, no recession. So that's our view. What inflation? There's been no inflation. So that's what's also allowed interest rates to stay low. That's what's allowed the US Central Bank, the European Central Bank, BOJ, BOK, BOT, BNM, whoever, to get interest rates down, to support stock markets, to support economies. If you look at this chart, look to the right of this chart, you will see a dark blue line, which is what markets had been forecasting. The green line below that is what it turned out to be. So inflation over the last year or so has perennially been below forecast. I think it's very hard to pinpoint the causes of it. Some people point to low oil prices. Some people point to the trade war and how growth has been weaker than expected. No matter the case, we've had no inflation, or very little inflation, which, as I've said, also allows for central banks to be easing, and rate cuts are forecasted globally. So, I've spoken about the background, and I've got 7 predictions for 2020. This is the Schroders house view. I'll come back in 12 months' time and tell you how I've done, and I hope by that time you all would have made a lot of money in the process. First prediction, we like equities. It's a difficult one to make if you think about it, because it would have been easy 12 months ago. Nonetheless, we make that prediction today. 2018 markets were down 8-9%. 2019 markets were up 27%. Year to date, we're up 1.5%. This is all the MSCI World Index in dollar terms. So we're up this year, but we continue to say that you can make money in equities this year, very broadly. And why do we say that? Now, if you look at this chart, it points, what tends to predominate? You see pink bars and blue bars. What do they mean? The pink bars are earnings, it represents earnings growth of the MSCI World Index, meaning global companies broadly. The blue lines, they can be above, they can be below. Above means markets are being re-rated. That means investors are willing to pay more and more for it. If it's below 0, it means investors think markets are too expensive and they should be selling. So very oddly, you can see that in the year 2018, it was very high earnings growth, more than 20%, and yet markets were being derated, right? It's very odd, isn't it? And what happened in 2018, we all remember Donald Trump, trade war, etc. 2019, it didn't stop, but by that time, investors felt markets had sold off enough, and even if earnings was not that strong, they were willing to reverse the derating. So the negative bars in blue got less and less, smaller and smaller. So that's why you made a lot of money last year. So what we're saying is that for this year, 2020, with the reversal of the derating and earnings growth this year around 10%, you can still make money. You may not make as much money as last year. I think it's unfair to expect to make 27% again, but there's still some money to be made, especially when growth has stabilized with the US and China trade truce for this moment. Liquidity, we still see easing in interest rates, and with the interest and with earnings still quite good. So that's our first prediction. We like equities very broadly. The next question you're going to ask me, which equities? Equities can mean anything. Can it be KLCI? Can it be, I don't know, Brazilian equities? Well, we have a couple ideas, so let me move on to number 2. We like NASDAQ. Perhaps, again, a little bit controversial, because you might think, well, NASDAQ is done very well already. It's not as cheap a market as most people would like or would think. And you would be right. You would be right to say all those things. However, you would be right also to know that the usage of technology is only going to increase. You know, just because you've been staring at your phone the whole evening, you know because your kids stare at their phone the whole evening, you know that you're buying and upgrading, and data centers the whole world over are being rebuilt and rebuilt and rebuilt by Google, by Facebook, by everybody. So you know that 5G adoption for telecoms is coming as well. So there's tons of spending on technology, and that is not going to stop. So NASDAQ is something we like. If you look at the chart on the left, the red line in the middle shows you the earnings of the NASDAQ index since 2001, and it's been rising very, very strongly. The red line below that is the S&P 500 index. It's been rising, but clearly not as strong. The blue line shows you the premium of the NASDAQ market, meaning how expensive it is relative to the US broad market. And that's been coming down. So I won't say that the NASDAQ market is cheaper than the S&P 500. It isn't. But the earnings growth is far better. So for example, I can tell you, NASDAQ is about 25 times PE this year. The S&P is 19. So NASDAQ is more expensive. But earnings growth for NASDAQ is 37% this year and 17% for the S&P. So we're willing to pay up for that growth. And that's our second prediction. Okay, so far, two predictions. We like equities, we like the NASDAQ. Let me move on to maybe something a little bit different, which is bonds. Asian credit, this is something we like as well. So when you have interest rates low, and we expect it to stay low with rate cuts by global central banks everywhere, you continue searching for income. You want certainty of income, you want dividends, you want yields. So this is what you can get, especially when there is still liquidity in the market and risk-taking continues. So why do I highlight the pink bars on the left? Well, one represents Asian investment grade, and then the one next to it is Asian high yield. And that's in comparison to IG bonds and high yield bonds in the rest of the world, whether it's global or US or Europe. So the first point to make is that Asian yields are higher compared to global yields, US yields, Euro yields. And should it be higher? Well, from our perspective, Asian corporates are doing very well, and you can see that from the charts on the right. The one above shows you EBITDA margins. This essentially explains the profitability of Asian companies. And it's been improving since bottoming out about 2012 or so. So Asian profitability is improving and stands at a good 15.5% for EBITDA margins. And at the same time, Asian corporate leverage has come down, and in fact is even lower compared to the US and European companies. So that's the yellow line on the bottom chart. Corporate leverage means the amount of borrowings which a company has, so the lower the better. So Asian companies are doing well. Asian economies are stable and improving. The US-China trade war is stabilizing, and as a result, we like Asian credit. Another thing to remind ourselves is that in emerging markets, the central banks have more room to cut interest rates, simply because they've got higher interest rates at the moment. If you look at on the left, what I've boxed in blue, those are all the several EM countries: India, Indonesia, China, Philippines, Malaysia. That's in Asia. And even further to the left of that would be global emerging markets like Mexico, Russia, etc. If you look to the middle and the right in yellow that I boxed up, those would be the developed market central interest rates. So much less room to cut. And even all the way out to the right, hardly anything. Negative interest rates. So more room to cut rates, therefore better for emerging markets, better for Asian, whether earnings or corporate credit, or for equities as well. And this would be our fourth prediction. We like EM and Asian equities. And this is where I would also concur with Jitun, that we like Asian equities. And quite simply, it's due to earnings, it's due to valuation. On the left, you see the PE ratio in green, which is the same or lower compared to global markets, and clearly much cheaper than the US. At the same time, you have earnings growth, which are the blue bars, which are higher, 12.4, 14.9, compared to the developed markets. So when you have earnings that are better and valuations that are cheaper, I think that warrants a buy. So that's what we like. And even from a price to book valuation perspective, which is the chart on the right, you will see that Asia looks much cheaper compared to the rest of the world. I mentioned income earlier. So aside from just Asian credit, we also like REITs. REITs did incredibly well in 2019, in fact more than 25%. And they continue, from our perspective, to look attractive in a low yield environment. Valuations are fair, which are what the chart on the left, the spread above SGS, 10 years. And REITs, the yield in Singapore is about 5%, a little over 5%. So that looks very good from our perspective. It compares much better than Australian REITs, Japanese REITs, Hong Kong REITs, etc. The only thing that does better is Asian high yield. So these are our top 5 predictions so far, how to make money. Very positive views based on our baseline scenario of where we think the global economy is going. No recession, 2.6% GDP growth, reasonable liquidity in markets, no inflation. That's the baseline scenario. But of course, you always have to plan just in case something goes wrong. In this day and age, it doesn't take very much to lob a couple missiles over the border and then something goes wrong. So what happens if recession does come? Or the other alternative, what happens if growth actually turns out better than expected? So that's on either side of our baseline scenario. How do we make money in such a case, or these cases? Well, let's just look at the first one, recession risk. It seems to have been rising, and that's the indicator in blue. It has been picking up in the last couple of months. It's eased off actually somewhat. If I update this chart, it would have come off a little bit. But for a while, it looked like things were actually getting worse. But this is of course before the phase 1 trade deal, etc., etc. So this brings me to my second question. How long did it take for the US economy to fall into a recession after the US 2-10-year yield curve inversion in 1988? Just to explain very briefly, what yield curve inversion means is that when the nearer interest rate, let's say for example the 2-year yield, is higher than the 10-year yield. That's not normal. That usually is what the bond market is telling you is going to lead to a recession. And in the past 10, 20 years, 30 years, there has been some of this inversion. And does it always lead to a recession? And how long before it does happen? So the answer to that question, well, is here, this one. It was actually 19 months later. It took a full year and a half from the yield curve inversion for recession to happen. That was in 88. Different for different years. For 2000, it was 10 months. For 2005, it was 24 months. And then in August last year, there was a yield curve inversion, but it's now reverted. So are you going to go back to that and say it's going to happen again? We say no. Some people are still a bit cautious. So I think this is something we have to consider and set as a scenario, as a what if. So the question is, what if we really do go into a recession? This is our prediction number 6. We like gold. Gold is a safe haven hedge, and it works opposite to market drawdowns. So if you look at the chart on the left, you will see that the years that the S&P 500 index was negative, that's the one in blue, gold did well, and that's the one in pink. So it's in the opposite direction. Why does this happen? Well, gold benefits when there's weak growth, there's low real yield, when there's increasing liquidity, and there's when increased political tension. So really, it's a hedge against growth. We think that this is something to consider when you feel that there's a risk of something happening. And we have been invested in gold for the last quarter or so, and it came in very handy just in the last 2 weeks when Trump decided to throw a drone strike at the general and gold shot up. So these things remind us that no matter how much you think you have a view, a very strong view on markets, it's always useful to have protection as a just in case. But of course, that's the other side of the coin. That's when things go wrong. What happens when things go really well? And most people will say, well, you're being too optimistic. Things can easily go wrong. We're happy with what we are. And that's fine, nothing wrong with that. But this has happened before. So if you look at all those episodes which are highlighted with the red arrow, you are in the yellow section, which is the slowdown. And then it goes green, meaning it expands again. It has happened time after time. It's hard to pinpoint again the logic, the reasoning, and it's very backward looking. So I'm not going to tell you it's going to happen, but you will know after it's happened, and that's the problem. So again, you want protection on the downside, but you may say, I want protection on the upside as well. So I want to make even more money when things turn out even better than expected. So from that perspective, I would say that we like US small cap equities. This chart shows you how the US small cap index, which is the Russell index, how it performs compared to, on the left, the US 10-year yields, and on the right, the ISM, which is essentially a measure of industrial activity, shall we say. So on the left, you can see that in blue, the small cap index will underperform relative to the S&P when yields are coming down, meaning when growth is getting worse and worse. But when yields turn up, you expect growth to improve. That's when the Russell will do much better. So if you think yields are going up because growth is great, buy the small cap. If you look to the right chart, it's the same thing, essentially. The ISM, if you think that that is going to reverse because industrial activity will pick up, buy the US small cap index, because that's a hedge on growth. So that's our top 7 predictions for 2020. We are always mindful of risks, and while we have our baseline scenario right there in the middle, we consider what will happen if wages accelerate, or if there's a global recession, or if there's a global trade war, et cetera, et cetera. So these are the various scenarios when growth can get better or worse, or when inflation can get better or worse, and we would position accordingly. Nonetheless, you have my top 7 predictions, and this is a quick summary, if you will, how we would position for the late cycle. First point, opportunities are always there. You can always make money in every market. I know it sounds difficult to believe, and especially when it's going down, it's painful. There are always opportunities. Greed, fear, duct tape, banana moments, call it what you will, there are always opportunities. So today, there are 3 factors driving markets, financial markets. Economic growth, which is kind of soft, but stable. Trade wars, which has gone away for the moment, but which may come back, I don't know. But one thing for sure, monetary policy remains accommodative, so liquidity is good. So how do you make money in this environment? You watch for signs of cyclical stabilization. That's happening at the moment. The tail risk, as a result, is less skewed to the downside, meaning it's better to take more risk at this time because of this cyclical stabilization. But at the same time, be aware of the alternate growth scenarios, and I pointed to the worst case scenario or the better case scenario. So finally, just the 7 again. We like equities, we like NASDAQ, we like Asian credit, EM, Asian equities, Sing REITs, and hedges on the downside. Well, a hedge on the downside, gold, hedge on the upside, US small cap. So that's it. Happy trading for 2020, happy money making for 2020. Thank you.